The silver market didn't just drop, it was sabotaged. The chart on your screen says correction, but the plumbing says crime scene. I've spent the last 72 hours tracing the mechanics of the COMEX, and I found the exact moment the commercials pulled the lever to flush the system. Most people see red candles and panic. They assume the price dropped because there were more sellers than buyers. That is the surface narrative. But if you look at the hydraulic pressure, the margin requirements, the timing of the trades, and the inventory flows, a completely different story emerges. We are witnessing a paper casino trying to price a strategic asset, and the disconnect has reached a breaking point. The thesis is simple. This was an engineered flush designed to clear leverage before the physical reality takes over. The price on the screen is a distraction. The evidence is in the plumbing. Let's look at the weapon used to commit this crime. It wasn't a change in supply and demand. It was a change in the rules of the game. To understand why silver plummeted from its all-time high of $84 down to $70 in a matter of hours, you have to look at the CME group and the margin requirements. On December 26th, silver was climbing past $80. The momentum was undeniable. Speculators were piling in, and the commercials, the bullion banks that are structurally short, were facing catastrophic losses. If the price kept going, the banks would have been forced to cover billions in bad bets, so the exchange intervened. On December 26th, they raised initial margin requirements from $20,000 to $22,000 per contract. That's a 10% hike. The market absorbed it. The price kept rising, so they hit it again. On the afternoon of December 29th, right as silver touched $84, they raised margins again, this time to $25,000. That is a 25% cumulative increase in 3 days. Here is why that matters. When you trade futures, you are trading with leverage. You don't put up the full value of the contract, you put up a deposit. When the exchange raises that deposit requirement by $5,000 per contract overnight, every trader holding a position has a choice. Wire millions of dollars in cash immediately or sell. This creates a leverage trap. It forces liquidation that has nothing to do with the asset's value. The selling you saw wasn't because people didn't want silver. It was because they couldn't afford the new entry fee to keep their positions open. It is a forced selling loop. The banks know this. They know exactly where the pain points are. They raise the requirements to force the weak hands to fold. But the timing reveals the intent. This flush didn't happen during peak global liquidity. It happened precisely when the Shanghai Gold Exchange was closing for the New Year holiday. China is the world's largest physical buyer. By triggering the margin calls while China was offline, they ensured there was no physical bid to support the price. They waited until the lights went out in Shanghai, then they changed the rules in New York. Now, look at the commercials' behavior during this drop. The commitment of traders reports show that while the managed money, the hedge funds and retail speculators, were puking their positions in a panic, the commercial banks were covering their shorts. They used the liquidity event they helped create to exit their losing bets. This wasn't a crash. It was a transfer. The volatility was a tool used to move ownership from weak hands, who trade on leverage, to strong hands, who trade for possession. This is the difference between the paper price and the physical reality. The price on the screen dropped $14. But did any physical metal flood the market? Did mines suddenly double their output? Did industrial users stop building solar panels? No. The physical market didn't flinch. In fact, as we will see, the physical market tightened. The paper market is a mechanism for setting a price, but it is no longer a mechanism for delivering metal. The flush cleared the leverage, but it didn't fill the vaults. And that is where the second fingerprint appears. The price on the screen is a distraction. To see the truth, we have to look at where the metal is actually going. If the price on the screen is a lie, where do we find the truth? We find it in the vault. And the vault is telling us that the system is bleeding to death. To understand the mechanics of this, you have to visualize the silver market as a bathtub. The water level represents the price. The faucet is the new supply coming from mines. The drain is the physical demand leaving the system. In a normal market, when the water level drops, when the price goes down, the drain should slow down. People sell, buyers wait, and inventory builds up. That is how markets find equilibrium. But that is not what happened here. This is where the forensic evidence becomes undeniable. While the paper price was being smashed down by margin hikes and algorithmic selling, the drain didn't close, it opened wider. Let's look at the hard numbers from the COMEX. In January 2025, the registered inventory, that is the silver that is actually warranted and available for delivery against futures contracts, sat at approximately 100 million ounces. It looked healthy, it looked stable. But by December 31st, after 12 months of this so-called bear market, that number had collapsed to 32 million ounces. Do the math. That is a 67% decline in available inventory in a single year. The bathtub is draining 3 times faster than it is being filled. But the most damning piece of evidence isn't just the total drop, it is when it happened. Look at the period from October 10th through December 31st. This was when the volatility was at its peak. This was when the crash was frightening retail investors out of their positions. During that exact window of panic, 53.5 million ounces were removed from the registered category. This is the invisible drain. While the price action was screaming, sell, the physical movement was screaming, acquire. This is the inverse of how a functioning market operates. When the price crashes, inventory usually accumulates because nobody wants to catch a falling knife. But here, the inventory vanished. Why? Because the entities taking delivery, the industrial giants and the sovereign wealth funds, do not care about the daily chart. They care about possession. They know that the paper market is built on a mechanism called rehypothecation. This is a sanitized financial term for a very dirty reality. For every 1 ounce of physical silver in the vault, there are hundreds of paper claims trading against it. In the casino of the futures market, that leverage works fine as long as nobody asks for the metal. Everyone is happy trading paper receipts. But when confidence cracks, the game of musical chairs stops. Industrial users like solar panel manufacturers, AI data centers, and EV makers are looking at that 32 million ounce number and realizing there aren't enough chairs. They are skipping the futures market entirely and taking direct delivery because they cannot print silver. This is a run on the bank, but instead of depositors lining up for cash, it is corporations lining up for bars. They are draining the eligible stocks before the rehypothecation scheme collapses. The paper market is trying to tell you that silver is abundant and cheap. The physical inventory is telling you that silver is disappearing at a rate that guarantees a shortage. The drain is open, the faucet is broken, and the water level is artificially low. This disconnect cannot last. It creates a split in reality, where the price you see is no longer the price you pay. And that leads us directly to the third fingerprint. If the vaults are draining and the demand is accelerating, why is the price on your screen still hovering in the 70s? The answer lies in the third fingerprint, and it is perhaps the most critical piece of evidence we have found. We are witnessing the death of the law of one price. For decades, we have operated under the assumption that silver is a global commodity with a unified price. Whether you were in New York, London, or Shanghai, the price of an ounce of silver was roughly the same, adjusted for shipping. That system is now broken. We have moved into a bifurcated reality where the paper price in the West has completely decoupled from the physical price in the East and the North. Look at the Shanghai Gold Exchange. While the COMEX in New York was orchestrating its margin flush to drive prices down, physical silver in Shanghai was trading at a premium of $8 to $30 per ounce over the Western spot price. That is a spread of nearly 20%. In a functioning market, this shouldn't exist. Arbitrage traders, the immune system of the market, would normally buy cheap silver in New York, fly it to Shanghai, sell it for the higher price, and pocket the difference. That buying pressure in New York would lift the price, and the selling in Shanghai would lower it, closing the gap. But the gap isn't closing, it is widening. This tells us something terrifying about the plumbing. The arbitrage mechanism is broken because the metal cannot be moved. You cannot buy physical bars in size in New York and get them to China fast enough to capture the spread. The metal is sticky. It is trapped in the friction of the real world, while the paper market trades in the frictionless world of digital derivatives. The flow of metal has become a one-way valve. Silver is flowing east to satisfy industrial hunger, and it is not coming back to bail out Western shorts. The evidence gets even more extreme when we look north. Reports from logistics providers in the Arctic, where strategic resource competition is heating up, show silver being quoted for physical delivery at prices as high as $137 per ounce. Compare that to the $70 on your screen. That is a disconnect of nearly 100%. Why would anyone pay $137 when the market price is $70? Because in the Arctic, silver isn't a speculative ticker symbol. It is a strategic resource essential for military and industrial operations. These buyers are paying for access, not just the metal. They are paying a scarcity premium because they know that at $70, the metal simply isn't available for delivery in the quantities and locations they require. This brings us to the concept of replacement cost risk, which is destroying the liquidity of Western dealers. Refiners and bullion dealers are refusing to sell at the spot price because they know they cannot replace their inventory at that price. If a dealer sells you a coin for spot plus $2, but it costs them spot plus $10 to get a new coin from the mint, they are selling themselves into bankruptcy. So they widen the spread. They detach from the spot price. We are moving from a unified global price to a fragmented system of regional scarcity pricing. The ticker symbol Zagosti is becoming irrelevant. What matters now is, do you have the metal and where is it located? The paper market is pricing a contract. The physical market is pricing a crisis. And this scarcity isn't just about investors trying to protect their wealth. It is about nations securing the inputs for the next century of industrial dominance. We have established that the price is broken and the vaults are emptying. But the final fingerprint explains why the urgency has spiked right now. Silver has graduated. It is no longer just a commodity or a monetary hedge. It has been reclassified as a strategic resource. Look closely at the Greenland discovery. The USGS quietly released data confirming a massive 2.03 billion ounce deposit in the Arctic. This report didn't surface randomly. It appeared precisely as geopolitical tensions over the region escalated. This confirms that major powers are no longer just trading silver, they are hunting for it. They understand that control over the next generation of energy and defense technology depends entirely on access to this metal. This explains the Arctic premium we discussed earlier. Nations are buying strategic access, not just ounces. Simultaneously, we are witnessing the weaponization of supply chains. As of January 1st, China's export licensing system is active. This acts as a geopolitical choke point. China refines the vast majority of the world's silver. By placing those exports behind a licensing wall, requiring specific credit lines and government approval for 44 approved companies, they have created a mechanism to restrict global supply at will. It is a one-way valve. Metal stays in China for domestic solar and military use, but requires government permission to leave. This brings us to a hard reality. You cannot sanction geology. Political mandates and tariffs in the West are disrupting the flow of metal, creating artificial shortages that the paper market cannot price in. We are already seeing the early signs of force majeure risks. Industrial buyers are waking up to the reality that their paper contracts are legally void if the metal cannot physically cross a border due to regulatory constraints. The smart money sees this. Governments like Russia and China are moving to secure silver reserves directly, removing them from the open market entirely. They are building strategic stockpiles, treating silver with the same reverence as oil or uranium. The evidence is overwhelming. The paper market volatility is a distraction from the physical acquisition race happening in the shadows. The forensic audit is complete. The verdict is clear. The crash was a paper event. A mechanical flush of leverage designed to shake out weak hands. But the physical market tells the true story. Inventories are screaming shortage, prices are bifurcated, and nations are hoarding strategic supply. We saw the margin hikes, the inventory drain, the Shanghai premiums, and now the geopolitical lockup. The evidence is in the plumbing, not the headlines. The bathtub reality is inescapable. The drain has concluded. The inventory buffer that suppressed prices for years is gone. We are now facing the mathematical inevitability of a supply shock in 2026. The window to acquire physical assets at these artificial paper prices is closing rapidly as the market fragments into regional realities. Do not be distracted by the noise on the screen. Watch the metal. Subscribe to this channel to follow the forensic trail and stay ahead of the repricing event. The ledger is closed.